This video we are going to talk about modern portfolio theory and capital market line. We will discuss about them and how they have relationship between capital market line and modern portfolio theory and what is important to know about them. Let's begin. Modern portfolio theory. We need to explain modern portfolio theory and interpret the Markowitz efficient frontier here. I would like to say that due to abundance of market data and market risk has attracted significant interest from academic since the 1915s. As a result, the numerous market risk models have since been developed criterion for a good market model is that it must have acceptable explanatory power without being unnecessarily complex. One of the most notable market risk researches was Henry Markowitz. So this theory and formulas belong to him. He laid the foundation for modern portfolio theory in the early 1915s, and Marcus' portfolio theory makes the following some assumption here. We have really important assumption about the Markowitz portfolio theory. Uh, First of all, we have some return, and all return must be have some distribution, of course. And what should be it? Returns always returns always must be normally distributed. If you don't have any normally distributed, if you have CAPM analysis, this is not true. I mean, this is really bullshit without normal distribution because all theory and all numerous application based on the normal distribution. This means that when evaluating utility, investors only consider the mean and variance return distribution. Okay, mean, I mean mu and variance, guys. Okay, variance return distribution. They ignore the vision from normality. I mean, they always ignore ignore skewness and kurtosis. Okay, they always ignoring skewness and kurtosis. So they ignore the vision from normality, such as skewness and kurtosis. Humans are always rational, they and risk averse. Markham defines a rational investor as someone who seeks to maximize their utility from investments. Furthermore, when presented into two investment opportunity at the same level of expected risk, uh, expected risk, rational investor always pick the investment opportunity which offer higher expected return. For instance, this is our expected return, and then this is our expected risk. Okay, sorry, risk and expected return. If you have 10 return and 5 risk, if you have 15 return and 10 risk, 13 risk and 5 275. A rational investor should be pick which one? Always, according to Markowitz theory or Harry Markowitz, always rational investor should pick this invest. Okay, because our risk is and our return have really good difference. They have two, three, and two, but it is have five. We have high and low risk and high return. Actually, this is not this is not easy to find in market, and it is not possible always. Not possible always. But I just want to tell you how they have relationship, expected return, and risk. So another chapter, I mean another assumption is capital markets are perfect. What does that mean? Capital markets always perfect, or capital market are perfect is market should be efficient, guys. Okay, market should be efficient. And political risk or risk-free rate and market data should be good relationship between them and casualty, because you'll have some analysis here like a regression or kurtosis scammness. They have really good relationship between and some intersections. Capital markets are perfect implies that investors do not pay taxes or commission. Another chapter is taxes or commission. Okay, they have unrestricted access to available information. Perfect competition exists among various market participants. Because taxes or commission should be ignored or really low, or and they have unrestricted access to available information or no secret information in the market. Always should be solved and unrestricted. Uh, According to uh, modern portfolio theory, investors are risk averse and they seek to minimize risk of their portfolio. For a given level of target return, this could be achieved by investing in multiple assets which are not perfectly correlated each other and their correlation coefficient P are less than 1. What does that mean? You always have P here. What I want to try to say you P is a correlation. Um, Correlation coefficient P should be less than 1, uh, because they could be achieved by investing in multiple assets which are not perfectly correlated with each other. So while portfolio returns are calculated here as weighted average individual asset returns, portfolio variance depend on correlation among assets. A correlation of +1 uh, offers always offers no diversification benefits and result in portfolio variance being weighted average of individual variance. I mean, when correlation is less than one, a diversification occurs and portfolio variance decline below weighted average individual variance. So lower correlation greater and benefits becomes with perfect negative correlation. So what I try to say, you look at this picture. Uh, we have P0 here. Sorry, we have P0 here and P1. Uh, a correlation plus one offers no diversification benefits as a result in portfolio variance being weighted average of individual variance. DB and DS in efficient correlation portfolio risk. This is represent what I want to say. When correlation is less than one, diversification occurs portfolio variance and declines below weighted average of individual variances. P equal is 1, P equal minus 1, I mean negative value. It is indeed possible to structure portfolio with zero variance. It's a synthetic, risk-free asset. And y-intercept blue curve here, efficient correlation portfolio risk. Okay, this is our risk. We will further explore mathematical correlation next chapter. We will see another explanation how they have connection and how we need to calculate our Sharpe ratio and risk-free rate. I just want to say about this picture, and you need to know them. Uh, but by holding a sufficiently large, diversified portfolio, and investors are able to reduce or even eliminate their amount company specific, I mean idiosyncratic specific risk is specific risk is idiosyncratic, uh, idiosyncratic symetric risk. Okay. Risk inherent and individual security. Example of company specific risk include accounting fraud, uh, plus and minus accounting fraud and cyber attacks. These are idiosyncratic risk and specific risk. Uh, accounting fraud and cyber attack, loss of key personnel, or any other issue which affects specific company without affecting return of the market. By holding well-diversified portfolio, importance event effective individual stock in the portfolio in diminishing it. In the portfolio become mostly exposed general market risk. It follows this pattern because when investor can diversify low or at low or at low or no cost, they must not accept to receive a compensation of unnecessary exposure to company-specific risk that it is diversifiable. The compensation that receive must exclusively be determined by either exposure market risk. Guys, okay. These are really important. I would like to say about market modern portfolio theory. We have efficient frontier. What does that mean, efficient frontier? Why we need to have it? Efficient frontier. Frontier. Rational investor maximize portfolio return per unit of risk. plotting all these maximum return various risk levels and efficient frontier, they are looking at their maximizing risk and how they have relationship in the per unit of risk, I mean Sharpe ratio. And I would like to draw a one efficient frontier here. I think this is really, it looks like easy to, I always remember it. We have like this curve and expected risk, sorry, expected return on portfolio, and we have sigma p, this is our risk, and then we have we need to have a curve here. Yes, this is G and F, F, E, and D, and C. Okay, and then this is B, and then this is I. Uh, we have curve, they have sigma curve. Oh yeah, okay. This point, need to change color, bro. Yeah, looks like the same. Anyway, um, plotting all these maximum return here, we have 16 between 0 and 18 between 0, right? Almost 0 point. Plotting all these maximum return for various risk level produce efficient frontier here. This is our efficient frontier, which representing blue, red. No, blue is last picture. Sorry, representing red curve. I mean this purple. Sorry, this purple curve passing through C, D, E, F, G shown in efficient frontier here. This is our efficient frontier. This is about always only sorry, our risk and return. Always risk and return. Point C is now global Marian's portfolio here. Really, point C are global variance portfolio because it is efficient portfolio offering smallest amount of total risk. Okay, we have 12 return and 2 risk. This is global variance portfolio here, and therefore leftmost point of the efficient frontier, points A and B lie on the so-called portfolio possibilities curve. This is lie, which an extension of efficient frontier below global minimum variance. C, however, points A and B or another points below the efficient portfolio here are considering insufficient because there is always portfolio directly above them efficient frontier offering higher return, same amount of total risk. So in general, any portfolio below efficient frontier is by definition insufficient, whereas the portfolio above efficient frontier is unattainable. In the absence of risk-free asset here, the only efficient portfolio are portfolios on the efficient frontier. Investors choose their position on the efficient frontier depending on their relatively risk aversion, and the risk seeker may choose hold portfolio G because they have really high risk and high return. If you are looking risk averse investor here, you should find on the G point. And another seeking lower risk may choose the D because they have really low risk and high risk. Relatively, these are risky, very high risky version, and they really wanna have risky asset and non-risky asset in the. At the other hand, we have capital market line here. Capital market line always, of course, relationship between T-bill or treasury bill. So far in our analysis, we have only consider risky portfolio. The next step is introduce capital market line mean is CPI. Um, oh, sorry, no, CML, capital market line. Next step is introduce risk-free asset and common practice used risk-free asset is US Treasury bill. Investor will combine risk asset with specific efficient portfolio that may maximize their risk adjusted rate of return. Does investor obtain line target transfer? Uh, I need to draw it to explain you because we need to have some tangent here. Look, we have same picture and ERP, right? And this is market return, and then this is market sigma. Okay, this is market sigma. So, oh, sorry. Bad idea. Bad idea. This is risk-free asset. Oops. This is capital market line. All right. And then we have a point here like a curve. I mean, they have a intersection here. Oops. Yeah. This is, of course, market portfolio. Market portfolio. And this is C and B portfolio. And then A. All right. This is our capital market line. And the risk-adjusted rate of return does investor obtain a line tangent of the efficient holes y intercept. Intercept is the risk-free rate of the return. This is a capital market line showing in assuming investor have identical expectation regarding expected return and the variance standard deviation are about variance standard deviation and covariance correlation homogeneous expectation because capital market are really about only variance standard deviation homogeneous expectation and covariance correlation. There will be only one tangency line which refer to capital market line here because it is assumed the only one capital market line um, that there is only one tendency portfolio which by definition becomes market portfolio. We can think of the market portfolio as the sorry. We can think of the market portfolio as the portfolio containing all risk asset classes in the world. In practice, stock market index is often used proxy for the market portfolio, such as a SP 500. Uh, SP 500, all investor hold same combination here, and of the risk-free asset and market tangency portfolio depending on their desired amount of total risk and return. For example, a more risk-averse investor may interest some of the money in the risk-free asset we reminder invested in the market, right? And investment may be located point A. This is really risky asset of the may be located at point A on the in the capital market line. More risk averse investor risk sorry this is not risk, so this is risk averse portfolio and risk averse investor, and at the point of the at the point of the am sorry, this is market portfolio. This is the point of the investors are lending at the risk-free rate because some of their money invested in treasuries. Whereas point of the they borrowing at the risk-free rate and using leverage magnify of investment in the market portfolio. So we have some formula here and the market capital line. We have like this formula here. Expected RP equal risk-free rate plus uh, market return minus risk-free rate. Risk-free rate divided by sigma m times sigma p. This looks like a Sharpe ratio or uh, trainer ratio maybe. They have really good relationship between them about Sharpe ratio and security market line. Maybe you know, the slope of the capital market equal Sharpe ratio, which will be looking at this slope of the capital market line. Slope of the capital market line equal to Sharpe ratio. So these are introducing modern portfolio theory and capital market line. Actually, these are really easy, only depends their risk and return. No more words about it. Uh, Next video, I wanna talk about capital asset pricing model and deriving, applying and Sharpe ratio and another ratios about the portfolio risk measure and performance measure. And we will discuss capital market. We will discuss about Japan portfolio management, and we will see better how we can calculate our betas and another ratios. So capital asset pricing model is really important to need to see. We will discuss about them. Thank you for watching me. Thanks for your attention. See you next video.